rates remain very low by historical standards, and bond market volatility is also extremely low. Joe and Roger, with the economy continuing to grow, do you think the bond market is overly complacent, or is it telling us something we should be paying attention to?
Right. Well, yeah, it's really not about the whole bond market, but clearly there are segments in which you can see credit spreads and credit risk spreads that are tight, especially compared to history. You see also volatility, of course, as you mentioned, of interest rates, and also in the equity markets, risk assets in general, so that is concerning. I don't know if it is really the market or it maybe it's investors or the way the investors are deciphering the code words that the Fed is trying to use in terms of our guidance. The Fed is trying to be transparent and trying to give as much information as possible, and investors tend to take that information too literal sometimes, and that's why the Fed is reminding investors that it's really data dependent. So the information the Fed gives depends on how they see the world right now, but if data change, they will change their view, right? Investors tend to think that the projections that the Fed shows are almost certain, and that could bring a little bit a sense of complacency to the markets that we are watching closely.
Yeah, I mean, volatility, as Roger points out, is extremely low, and it could persist, although history shows that it rarely persists for long. And so, historically, unexpected shocks on the economy or the policy front could jar volatility higher for a time. I mean, one area that we contemplate potentially is that there is a growing risk that either because of a combination of decent job growth going forward in the United States, as well as still weak labor force participation, or those Americans that perhaps have dropped out of labor force come back in, they don't come back to such a vigorous pace that the unemployment rate before the end of the year could be below 6%, which is not in the Federal Reserve's projections. That would change the conversation. So again, I would say returns the past several years have been extremely strong. But if you look at low levels of volatility, they're commensurate with compressed risk premiums. But I think it's an outlook where the stronger the returns more recently have been, I think the lower the expected future returns we should have. And so I think at the margin, investors should at least reassess before taking more aggressive risk positions, because investors have been rewarded. They are unlikely to be rewarded to the same extent going forward.